From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 25th. You're listening to the Macrocast. This is Tony Fratto in New York City. We have Brendan Walsh and John Fagan from Markets Policy Partners in the Washington, D.C. area. And also joining us from D.C. is our old friend and colleague, mentor, Mark Sobel, who we got to know working together at the Treasury Department, now the U.S. chairman of OMFIF, the Official Monetary and Financial Institution Forum, and just leading so much great commentary and analysis there. If you, I'm gonna repeat this a couple times, but you should go to OMFIF, OMFIF. You should read their stuff. You should read the stuff that Mark writes. You should listen to their podcast because it's all all the kinds of smart, interesting, nerdy analysis of the big macroeconomic issues that we pay attention to. So we're just really lucky to have you here, and to have you here, on a week following a whole run of sanctions being posed by the United States, Europe, and other allies on Russia. And I will tell you, the most common question I've gotten, believe it or not, over the past month has been, and you can tell the kind of nerdy friends I have, is aren't you worried about the dollar, this sort of dollar imperialism that the United States is doing in placing these sanctions, especially the sanction on the central bank and SWIFT, and aren't you worried? And people would pass me around all of these kind of scaremonger stories, and I would make the case for why I'm not particularly worried about it. And then you wrote a really excellent piece. We've had these conversations before. Your piece, which is, I think if I remember the title correctly, is the red herring is back. Did I get that right?
It's Russia sanctions, the renminbi, and the dollar's future, the red herring returns. And
red herring
on the OMFIF webpage.
Yeah, it was had like a Batman kind of ring to it. And so I just started sending around your nice, concise column to help educate people on why. But could you talk us through this already? I mean, outline the issue and educate our listeners a little bit on why we should not be so worried about this right now.
Well, thank you for having me. Thanks for the good plug. I want the record to show that I didn't pay you to do that. So in my piece, I started perhaps a bit flippantly, but I noted that it was over 55 years ago that the French finance minister Giscard d'Estaing complained about the exorbitant privilege. And I noted that it's still here, so to speak, or dollar domination or dominance is still here. And then I went through a bunch of questions surrounding whether the dollar's dominant status would be impacted by the current situation. The first question I ask is, will the tough financial sanctions break the buck? I've been influenced by my conversations with Danny Glazer and others that have come out of the Treasury section that was responsible for the sanctions. And they make the point that the U.S. should never forswear the ability to deploy bilateral sanctions. I believe you can't use them excessively. I believe you need to be cautious in your use of secondary sanctions, especially cautious there. But the sanctions that have been deployed against Russia are undertaken with our allies, so they're multilateral, and they're part of a concerted strategy to basically cripple the Russian economy. And so I think that there's little reason to believe that our allies are going to seek to diversify out of dollars given this context. And given the upsurge in Western unity, it might even be pro-dollar, so to speak. So the next question I tackled is, well, China's no ally of the United States, isn't going to have incentives to protect itself. And I think China is going to have to seriously reflect on the spate of Western sanctions and what it can do to protect itself from such measures. And some other countries may as well, including in the Mideast, where some of them are large holders of dollars and haven't been particularly happy with the U.S. as of late. But it's easier said than done. So I expect China to use the RMB more widely for trade settlement. I think it'll try to build out its cross-border interbank payment system. I expect that the RMB's role may grow modestly in coming years. But for the RMB to play a significantly expanded role, it needs to develop open and robust capital markets. It needs to let the RMB float, be convertible. It needs to respect property rights and make the central bank independent. And while China, after 2008, and also then when the RMB entered the SDR basket, used that to try and promote market liberalization. The gains were limited. So to me, China is still more interested in a visible hand, not the invisible hand. And I also think China is not going to help Russia create financial lifelines to bypass sanctions in the dollar. So the Russian economy is small, 2 to 3% of the global economy. It's said it's getting smaller. And meanwhile, China is integrated extensively into the global economy. I believe it'll take advantage of Russia and get cheap oil, but I don't think it's going to put its global linkages at risk for Russia. And we've already seen Chinese officials saying they don't want to be impacted by the West sanctions against Russia. So another question then is, will reserve managers, especially in Asia and the Mideast, quickly leave the dollars? And reserve managers are always interested in diversification, but they also need to invest their funds. And there's simply no capital market in the world with America's depth, liquidity, and absorptive capacity. U.S. financial networks are already efficient. They're well established. And there's inertia in financial markets and searching for a new network. I don't see the euro able to play the role given limitations on European capital markets. I think there's some emerging markets, and Canada, Australia also offer attractive opportunities, but there are limits to how deep those capital markets. Another question that comes up frequently is crypto as a means of evading sanctions. I think that the vaunted anonymity of crypto is much exaggerated. The ability to transact in crypto is limited. And then stable coins, people talk about, but those are pegged to the dollar often. For the reasons I've mentioned, I don't see even the digital RMB as a threat to the dollar. So let me wrap up. 2 points. First, the biggest challenge to the dollar's future is us, the United States of America. I think if we run our economy decently, we maintain our openness, we behave responsibly abroad, we avoid excessive unilateral use of financial sanctions, the dollar's role as a global reserve and financing vehicle should remain well entrenched. That doesn't mean it won't decline. Again, the RMB's role may modestly grow and alternative investments may increase their shares as well. But there is little foreseeable alternative to the dollar that I see at this time, even after more than 55 years after we started hearing about the exorbitant privilege.
Mark, thanks for that, for laying that out. And there's so many questions that come from that. One is that it's embedded in every question about this that I get, especially from Americans, is the belief that it's an unalloyed good that the dollar is the most dominant reserve currency in the world. And first of all, is that the case, right? I mean, I think the perception seems to be that the U.S. would be significantly damaged if there were some diversification in global reserves away from the dollar. Is that true?
I often joke with my counterparts from the world, and perhaps this doesn't increase my already limited popularity, but I say, well, if the privilege is so exorbitant, why don't you guys want it? And it hadn't.
They don't
happened.
seem to be. Yeah, they're not taking you up on that, right? I mean, it seems to me that Europe has been. I think that in some ways even a hope that the euro could shoulder some of the load of being the reserve currency, but they don't seem to be interested in over maybe 20 or 30 years now of imploring to do the kinds of things that they need to do to allow that to happen.
No, I suppose maybe the war could accelerate that on the Europe front, where now they are issuing some war bonds together. Not that it's going to happen overnight, but in terms of issuing debt at the Eurozone level.
Yeah, galvanizing to Europe as an entity, as a political entity. But certainly, we have seen obviously this weighing heavily on the euro as a currency, and its proximity to the situation obviously in Ukraine and dependence on Russian oil and so forth. It's it's certainly a rare thing to have a currency like the dollar, and maybe this is obviously part of the exorbitant privilege that is a safe haven and tends to rally when when the world is in a challenging spot. And we've seen these counterintuitive kind of moments over your career, Mark and Tony. The downgrade of the United States, what does the dollar do? Rallies. What do treasuries do? They rally. And because there's uncertainty. And it really is it's a situation in which, I think you made a very salient point, Mark, about reserve managers. And I know you worked, and Tony, you worked closely with the Exchange Stabilization Fund in the U.S., which is it's relatively small from what passes as sort of like a sovereign wealth fund light almost in the U.S. It's $100 billion, but
is it $100 billion right now?
Something close to that, isn't that right, Mark? 90.
The FX SDR dollar portion of it, the dollar international side, is over 100. It under the Trump administration, a lot of the pandemic response was brought into it, and it swelled, I think, to $500 million.
Interesting.
But basically, 100 billion is the part of it that we're talking about. So Tony, let me just come back to your basic question. I think it's an important one, because I don't actually believe there is an exorbitant privilege. I believe that the U.S. benefits on net from the dollar's role. So we get cheaper financing, we get seniorage, Americans are shielded from FX risks. Lately, a lot of commentators point out that the dollar's role gives us geonomic power because we can deploy the sanctions if done wisely. But there are costs of it, as you well know. So the dollar tends to be overvalued. I realize that's a loaded term and you can't measure it, but let's just stipulate overvalued for the sake of the argument. And that is associated with negative trade bounces. The Fed has to step up in crises and go beyond where it probably wants to. So there are costs. And then to come back to an issue that all of us know really well, and Tony especially based upon his time at Treasury when he had to put up with me, when the trade bounce, the trade deficit becomes an issue, it's going to spill over into the currency realm. And that puts a lot of pressure on the Treasury because, we have to do the currency diplomacy, and there may be reasons why the dollar is so strong or why we're running a trade deficit for macro reasons. But people want protectionist action at the time, which Treasury doesn't want. And so you're triangulating between trying your currency diplomacy to stave off protectionism while keeping the hills somewhat at bay. And it's a very difficult issue for the Treasury when it crops up, as it did in the 2004 through 14 period because of the RMB. So I think that it's not exorbitant. And so I agree with the thrust of where Tony was headed in his original question.
We think about the sort of the share. I mean, I don't have the numbers in front of me, but my recollection of share of global reserves is something like the United States at somewhere around 60% the share. The EU 22%, somewhere right around there. The yen at maybe under 10%.
Oh, yeah. Yen and sterling, I think, are under 5.
Yeah, sterling under 5. So about 85 to 90% are in sort of, like-minded countries. I don't know, you throw the Australian dollar, Switzerland, Nordics, some other handful of Canada in there. And what are we really talking about, right? I mean, the renminbi is around 2% or 3%. When I would say, people say to be deterioration in the dollar, I said, deterioration to what exactly? It would have to be one of those choices, right?
Yeah, and part of that stability as a reserve manager, we've all kind of had that experience dealing with the Exchange Stabilization Fund. When you're making the choices of where to allocate, you are dealing with the absorptive capacity of these markets. You've got you've got a lot of zeros that you've got to put in places. And the idea that you can just say, I'll put a bunch in Norwegian bonds. Well, those are teeny tiny little markets and compared to the Treasury market. And it's just, it's not even close. The liquidity that you absolutely require as a reserve manager, and also the other aspects that you bring forward, Mark, the property, the enforceable property rights, some of these things. It's such a challenge, even with the choices that you have to diversification. There was a reason diversification has been slow, and that is one of them. The completely unequal sizes and depths and quality of these markets. But
in markets like Canada and Australia, they have huge retirement savings that are mandated to buy Australian or Canadian. So you're just pushed out of the market as it is.
Yeah.
But even in America, it was really enlightening when we were at the hedge fund that, the Treasury market is the deepest market in the world. And when we issue debt, it gets bought, but that's bought by the pension funds and sovereigns. If you want to trade treasuries, it's not that easy. It takes a little while to fill a treasury order. If I want to buy, say $100 million of 2-year notes, they're not floating around because they're very much in demand. And the people that buy them from the treasury don't tend to sell them.
Right. And take that kind of liquidity issue and magnify it by, a factor of 1,000. And you're talking about some of these diversifications into the renminbi. What are the standards? Obviously, everybody knows roughly the kind of standards that you have to abide by to be a card carrying member of the global dollar system, right? You don't know exactly where the red lines are, but as one guy was quoted as saying, megalomaniacal attacks and historical crimes on on neighboring countries is going to get you kicked out of it. Any rational global order has to have rules that get you bounced out of it if you don't abide by them. Otherwise, why wouldn't we let North Korea in? Yeah. Right. And so by any rational metric, Russia has violated those norms, and simply it's just the right thing to do to apply these kind of constrictions. But when you think about diversification into China, what's their threshold for denying you access to your renminbi reserves? It's probably a lot different. It's probably something along the lines of you disagreed publicly with China on something. That I think is something that the reserves are so small in renminbi right now. No one really even has to confront that kind of question. But as you get into if you even try to make the leap into that next level where you're getting closer to the Australian and that, then you have to confront those questions more deeply.
Mark, when we were at Treasury together, and going back even 20 years ago, and having these conversations about China and Chinese currency and encouraging them to do some of the things with capital markets opening, they prefer capital controls. They prefer having a lot more command and control over the financial sector. Then would allow them to, have a currency regime that people would want to hold renminbi for any length of time or any time beyond just their immediate needs. But one thing that the Chinese seem to desire is because as much as they truly do not want to have the RMB as a reserve currency. They don't want the dollar to be such a strong reserve currency. They've pointed to SDRs. You mentioned SDRs earlier. We hold some of them in the Exchange Stabilization Fund. Should we expect to see more SDR holdings? What are have we seen any over that time? Any significant increase over that time?
So there was a $250 billion SDR allocation at the time of the global financial crisis. And there was a $650 billion allocation in 2021. So obviously, when you allocate to IMF members according to their quotas, SDR holdings go up. So the question is the usability thereof, right? Yeah. And so if you give the United States a bunch of SDR or Germany, there's no great need for them, right?
Mark, actually, I'm going to interrupt for just a second because I'm presuming that like literally everybody in my audience knows, our audience knows what SDRs are, and that's not necessary. No, there's no special reason why that would be the case. SDRs are IMF special drawing rights,
special drawing rights money, special drawing rights.
Yep.
And we always think about IMF programs. That's something in the finance by quotas and something called the general resources account. But there's this own separate something called the SDR department, where SDRs can be allocated with an 85% majority of the fund's voted power. And so with the stroke of a pen, you create reserves and you give them to countries according to their share in the fund. So the US will get 17.5% of them. Germany 5, China 6, Japan 6, et cetera, and basically what you find is the advanced economies and many emerging markets that have tons of reserves, such as China and Brazil, India, they don't really need the SDR, because what you do with an SDR when you need foreign exchange is you sell the SDR. So an emerging market country that's facing stress may sell its SDR, and it ends up in the United States and on the ESF's books, and we give one SDR we give the dollar equivalent of the SDR to that emerging market country. The emerging market country can then use it for whatever general balance payments purposes. And so what we've found is that very little use is made of the special drawing rights. Some of the emerging markets, some low-income countries use them, but it was very modest in the 2009 allocation. We'll have to see what the current situation is. I know Argentina used it to pay back some of its debts to the IMF, but otherwise, I don't think it's been particularly extensive. Mm-hmm. Look, if the world wanted SDRs, it would have gone to it a long time ago. If the private markets had wanted to replicate the SDR, if they can create CDO squares or whatever the heck, CDO cubes, they can create SDRs, but the market hasn't demanded it. I'm on the skeptical camp about the world moving to some kind of synthetic asset. We live in a world of nation states. They're national currencies. The U.S. is the largest national currency. The Fed is the world's global lender of last resort, very reluctantly and in a pinch, but we have national currencies, not synthetic SDRs.
As part of that obligation of, if you are the reserve currency, it comes with if there is any privilege. I think I'm with you on this, that there is, on balance, it's a net positive for the United States, but there for lots of different reasons. The burden is you show up with having to provide lots of dollars and swap lines when things get really dangerous out there, which puts there's risk associated with that as well. But that is like the sort of the burden, the obligation to do those things. It's not obvious to me that other countries, the European ECB certainly would and has done it, but that other countries have the same interest or to be able to do it in the magnitudes that are necessary. But it is a huge obligation of the United States to be able to do that in times of stress, isn't it?
It is. Again, to me, the two biggest costs are the trade situation that I discussed, but then the one that you're speaking about. But again, the dollar is the global currency. So in essence, what you find is that what the Fed is doing when there's a financial crisis around the world of the 2008-9 or the pandemic variety is you're sustaining the viability of the global dollar network, which underpins really the global economy. So if you go back to the global financial crisis, a lot of the European banks in particular needed wholesale dollar funding, and they weren't able to get it viably in the swap market, in the FX cross basis point swap market. And so the Fed provides a line to the ECB. The ECB can lend dollars to the European banks. And we get through this situation. So you're absolutely right, Tony. It does impose a burden on the Fed when the global economy is in a severe pinch.
Just a question. So your background, Mark, many of our listeners, I'm sure, know that you were really the point man for the dollar. You were the point man for the Treasury on an international basis, not just the dollar, but a whole variety of policies for many years. And you were the guy that everyone was scared of. Yeah, you were the dispenser of tough love, I think, to our allies and around the world. Some refer to you even as the heavy in the room in certain cases. So with that background, when we look around the world, and you mentioned it as well, the petrodollar, the Gulf, when the scare stories around the dollar's reserve status cracking often revolve around the behavior that we've seen of Gulf countries being receptive to a potential purchase of, the potential purchase of oil in renminbi and that sort of stuff. What would you be saying right now in this circumstance to our allies and our friends in the Gulf on this sort of petrodollar aspect? Is this just another red herring that that would be as superficial as some of the other potential threats to the dollar?
Well, I thank you guys for thinking that I had any power whatsoever. I'm a bit nicer than being the heavy. I remember I had a friend at the Fed who said, "I do monetary policy, Mark does the dollar," and I think he was mocking me at the time. What would I be saying to the petrodollar holders? Look, I think that relations between the U.S. and a lot of the some of the Mideastern powers are a bit strained right now. But and I think there's a broader foreign policy question there. So you saw the Saudis talking about denominating oil in was it RMB? I didn't really take that seriously because their currency is pegged to the dollar. And they're kind of calling, I think they're asking, according to the FT today, they're looking for more U.S. weaponry and whatnot. So I took that with a grain of salt. Look, I think those guys understand what we were discussing earlier. The dollar is dominant. They've got a lot of money. They got to invest it somewhere. Maybe at the margins, they can figure out different ways of doing it. They know that. Over the years, Treasury has always maintained a dialogue with these countries about the Treasury markets, about the U.S. financial markets. So I think, that's probably what I think the Treasury should be doing, is just maintaining open lines of communications. The broader foreign policy aspects of it all are going to be made elsewhere, and finance will be a component of that.
Just a follow-on question. One of the other aspects, we get a lot of questions about, the Treasury doesn't say very much about the dollar, or the Treasury Secretary's statement about the dollar is very, very boring and same old formulation and that sort of thing. And when I was at the Treasury, and you're having internal conversations about it, the kinds of thought processes and the kinds of intellectual sparring that goes on behind the scenes that feeds into the relatively terse external commentary about the dollar is really I think it's a fascinating dynamic that the public isn't and is, I think, purposefully shielded from. So in this kind of conversation, Mark, how do you think the commentary within the Treasury is going in terms of weighing the costs and benefits? Do you think that there's an attention, as you say, to perhaps some of the countermeasures that we can institute back home and focus on domestic policies that help shore up the dollar's status? Cleaning up our own house, so to speak, in order to perpetuate it?
Okay, so first of all, there's the whole public thing. Basically, Secretary Rubin said, we had a strong dollar policy. That came in at a time when the dollar was weak after the Benson era. I think he realized, and his successors realized, that there's very little point in talking about it. The markets are going to do what they do. If you say anything, it's going to cause market volatility. If you're going to even say something sensible about it, somebody's going to misinterpret it and it's going to cause volatility. If you ask a Secretary of the Treasury, Well, in an economic textbooks, if a currency depreciates, all other things being equal, will U.S. exports go up? Well, of course, 101 answer is yes. But if you answer that question, you're going to send the markets tanking. So basically, you have this Potemkin village. We have a strong dollar policy, and you don't even say it unless somebody asks you, right? And so you just avoid the whole thing. And, if you say, if the dollar's tanking and somebody says, do you still have a strong dollar policy? And you say yes, then people are going to say, well, what are you going to do about it? If the dollar's rising and people say, do you have a strong dollar policy? And you say yes, then they're going to ask you, well, what's your pain level? So you just don't comment. You try and avoid it. And then you give this meaningless statement and you just ignore the whole thing. So I think that's where everybody was except for the Trump Treasury. And Mnuchin was quiet, but Trump wasn't. So behind the scenes, costs and benefits and what kind of discussions goes on. Look, I think if you're keeping an eye on these things for private discussions behind the scenes, you're keeping a close eye on what are the state of the markets. Are they disorderly or are they liquid and bid offer spreads reasonable and is activity getting done? You might look at misalignments, right? There can get to a point where currencies are so out of whack, you worry about them. But then the question is, are they out of whack because of fundamentals? And what do you do about the fundamentals or not and whatnot? And then, there may be times where you do want to jawbone a little bit to send messages to the markets. In 2008, we did so on a few occasions. In terms of costs and benefits, I don't think that people, are gung-ho cowboys running around thinking, oh, what's the dollar? This gives us so much power. That having been said, when financial sanctions are deployed, I think there's usually a discussion about how does this impact the dollar's role in the global financial system, our responsibilities to the global financial system. So again, I wasn't there during the Trump administration. I kind of have this feeling that the Trump administration excessively used bilateral financial sanctions or unilaterally used them. But I know that particularly when the Iran sanctions were being discussed and whatnot, there was a healthy discussion about these broader issues about the U.S. responsibility to the global system and how did it fit in. And I think that that's an important matter. And Jack Lew gave a speech several years ago where he very explicitly discussed this issue.
Mark, I wish we had like another half an hour just to talk dollar policy and the words that we would string together.
And maybe next time we can get Brad Setzer on so you guys can yell at each other like the old days.
Brad would have been wrong.
Brad's dark in the depths of making administration policy now. I don't know when he ever emerges. Would love to get him on and have that debate.
To be fair to Brad, he's brilliant. He's a wonderful analyst, and a lot of the points he makes are always correct. How you formulate that into policy and take the analysis and steer it is always a tough question for policymakers. But he's one of the most brilliant analysts, whether you agree with him or not, that I've ever met.
Mark, thanks so much for joining us. I can't tell you how much we appreciate it. One of the things I missed when I left Treasury was the ability to just like walk into your office and ask an erstwhile, ignorant question, but walk out of it smarter than everybody else. So happy to get a chance to do that with you here on the Macrocast. So thanks for the time and the insight. And a reminder to the audience, Mark is the U.S. chairman of OMFIF. Had a brilliant career at Treasury Department and the IMF. One of my favorite economists anywhere. We can read him at OMFIF. It's at www.omfif.com. Mark, is that correct?
.org.
Thank you. Thanks, John, for correcting that. omfif.org. You can read him there. You can listen to the OMFIF podcasts, which are really terrific. Mark, we look forward to having you back again soon.
Thank you for having me.
And we'll see you next week on the Macrocast. John, Brendan, have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.